Good day, ladies and gentlemen, and welcome to our class on CFD trading, contract for difference, the fastest growing investment vehicle in the markets today. Now, I would appreciate it very much if you would click down below on the subscribe button or the bell icon. I promise you we won't barrage you with emails or bother you. Just whenever I upload a new video, you'll get a little notification. So please subscribe. It really means a difference for me. Thank you. Now, we're going to talk today about the 5 W's of CFD trading. The who, what's, where's, why's, and when's. Now, CFD trading is becoming the fastest growing online trading vehicle in the world. CFDs are approved and regulated by almost all European and Asian regulators. So it's an accepted, regulated, licensed investment tool. Now, CFDs stand for contract for difference. Okay, what does this mean? Well, the typical financial instrument allows you to benefit from fluctuations in the price of stocks, commodities, indices, and more without really purchasing them. That gets a little bit confusing. Now, let's use the stock market for our example. If you wanted to buy some shares of Google because you thought Google's going to go up in the next few days because you knew their earnings report was coming out or something positive was coming out, or the tech stocks were going to jump for whatever reason, you'd call your stockbroker and tell him you want to buy 100 shares of Google at $150 a piece. And he would say, okay, transfer me $150 times 100, or I'm not really fast on math, 150, 15, transfer me $15,000. You pay for the shares, he charges you a commission. The shares are issued in your name. And of course your broker holds on to them. You could in a short period of time have the shares sent to you and you'd physically get the certificates, but that takes quite a while and is very rarely done anymore. But you can, but your broker holds them and they are issued and they're on the books of the company in your name. All that takes time, effort, and money, costs, which are all reflected in what you're charged to purchase these shares. Now, the fact is, you only want to hold these shares till it's Monday and you want to sell them on Friday because you think the move is going to happen by Friday. Now, by Friday, you're trying to sell them and the shares haven't even really, you can sell them at any time you want, but the certificates haven't been issued in your name. They haven't been sent to you. Okay, it's a whole bunch of mess if you actually want these physical certificates. It's even a whole bunch more mess if you want to actually have the ownership. But it's done. Now, on a CFD, what you have is a contract between you and your broker. And it's a contract for the difference in the value of the asset. Now, it is regulated, it is standardized, there's no hodgepodge. So if Google is trading at 150, the CFD will be trading at 150 plus the spread, which is in CFDs, you don't pay commission. It's a slight difference between a buy and a sell cost. To give you an easier way to understand it is, when you went on vacation and you went to the commission store to sell your pounds and buy euros, there was a price in which you could buy euros. There's a slightly different price in which you could sell euros because the commission store no longer charges commission; they charge a spread. The difference between a buy and a sell. Now, the more popular an asset, the tighter the spread is, and they're insignificant. They're very, very tiny points. Most, say, Forex are 7 to 8 pips. That is your cost to spread. That's all the way. That's 4 decimals to the right. But instead of commissions, when you're trading CFDs, you're buying at the buy price and you're selling at the sell price. Now, the contract you have with your broker, okay, like I said, which is regulated and licensed, and the contract you have with my broker, the contract you have with the broker across town, the contract, it's the same thing because they're all based on that one share of Google, which is the same share of Google. But the contract simply says that you are having a contract for the value of your 100 shares of Google at $15,000, and you are buying these shares of Google, and when you close your contract, you will be paid the difference between the buy price and the sell price. Now, all contracts require two sides. If you buy, so if you wanted to buy Google as your stockbroker, you'd buy them. When you're ready to sell them for profit, you're selling them. What you can't do with your stockbroker is sell before you buy. That's a little bit confusing. But in CFD format, since it's simply the difference, you can, if you think Google's going to go down, and this is the hardest concept for people to grasp, but if you think Google's going to go down in value, you can sell them now at, say, that 150 price. And you sold them into the open market. You sold something you don't own. But you're going to have to buy them back to close your position. Now, if Google happened to go up, and Google, you sold them at 150, and now Google's at 155, you have to go in that market and buy them at 155. That means you lost $5 per share. But if you're right and Google fell from 150 to 145, you sold them at 150, you bought them back to deliver or replace at 145, and you made the $5. So it's the exact opposite of what you expect. So in a CFD, you must have a buy and a sell. Okay. Time is unimportant. To close your contract, you must execute the opposite direction of how you opened your contract. Okay. So each contract remains open until the opposite is done. And your profit or your loss is the difference between those two values. So CFDs, one of the biggest benefits is they allow you to go long as well as short. Now, a CFD is a leveraged derivative financial product. CFDs are derivatives because their value is derived from the value of another asset. So your CFD value is derived from the value of Google, and they mirror the movement of Google price. So, for example, you might want to buy a CFD go long for company X, Y, and Z. If the price of company X, Y, and Z shares rise and you close out your CFD, the seller of the CFD, the counterparty, your broker, will pay you the difference between the current price of the shares and the price that you took out the contract. However, if the price of the contract shares falls, then you would have to pay the difference in the price. This could mean many times the amount of money you originally put in. And this is one of the biggest benefits of CFDs, but it's also, what you have to remember, is the biggest risk. Because CFDs are leveraged products, means that as your stockbroker, you had to put up the $15,000. You had to wire him the cold hard cash. In a CFD, this broker doesn't set the leverage. That is set by the regulator. So let's use a hypothetical. In stocks, it's 10 to 1. That means to buy those 150 shares of Google, those 100 shares of Google at $150, which have a value of $15,000, you'd only have to put up as a deposit, not a cost, not a fee, but as a deposit, $1,500. So hypothetically, if you had $15,000 to spend, you could tie up 1,000 shares of Google. And so if Google went up to $5 a share you were expecting, you could have made $5,000. But if you're wrong and Google went down $5, you could lose $5,000. The profit mirrors the loss and is all magnified by that leverage amount. But there's ways to prevent that. We have something that's called a stop loss. Okay, in a CFD, say you buy Google and you expect it to go up from 150 to 155. Okay. You can set it up in the computer that if it falls at 140 to 148 at any time, to close your contract. So the most loss you could have would be $2. Okay, but you decide what your risk and reward ratio will be. So finally, it cannot be stressed enough that trading in the financial markets carries a high level of risk and may not be suitable for everyone. Before deciding to trade foreign exchange Forex or any other type of CFDs, because you can trade cryptocurrency in CFD, you can trade gold and oil, you can trade all commodities in CFD format, you can even trade ETF. There's almost every asset can be traded in a CFD format. Okay. Remember, because they're leveraged products, you can stand a loss of some or all of your investment. Now, don't be intimidated or confused by terminology. that seems to have nothing to do with the assets themselves. Like we talk about spot. Spot is the market, the real cash market. If we say gold is trading at 145, $1,450, that's in the market, whether it's the option market, the commodities market. Okay, what you're going to get today at the gold dealer when you want to take physical delivery, that's called the spot. In other words, if you want to buy copper piping and you need a lot of it, it's the price that the guy who's going to actually deliver the copper piping is going to charge you for the copper, because that's the spot, that's the cash price. Now, CFDs are like futures, okay, because you're trading something based on the future value. So, to give you an example, if you want to buy gold, you could buy spot gold. Spot gold is the price you're paying physically to take physical delivery of the gold. So the price, which would be the same as a physical asset itself. You could buy a gold CFD, you could buy a gold future, you could buy a gold certificate. But these have fluctuations and they're all likely to be very, very similar. And they all move in the same way. But there's a difference value between the gold you want to take today, because if gold was at $1,500 yesterday and fell this morning to $1,450, the guy physically delivering the gold to you that's got it in his jewelry box or in his jewelry shop, he's not going to drop it just because the market dropped $50 last night, because he needs an average price. Okay, and that's the spot price. Now, there's a big debate between CFDs and futures and Forex. Okay, and it's really a big waste of time. Spot and CFDs are essentially the same thing at this level. Okay, because believe me, you and I are not big enough investors that any of this makes a difference to us. Yes, if we're a hedge fund and we're investing millions of dollars, we want a difference in a spread, or a difference in a cost, or a difference in a commission, or a difference of 1/10 of a penny for 1,000 euros makes a difference of like a euro. But 1/10 of a penny when you're buying 1,000,000,000 euros makes a big difference. So when it comes to Forex versus futures versus CFDs, you will almost certainly find the major spot Forex pairs are, first of all, the big Forex pairs, if you're trading Forex, are the most liquid. They have the lowest spread, the lowest cost. Plus, they're the most trade. They have the most knowledge. They have the most information coming about the markets. You have all the data you need. When you go to very rare assets that are traded very, the liquidity is very short. There's not many liquidity providers, and the markets are very tight, especially exotics. If you want to trade, and you're in the U.S. or you're in the U.K., you're in even if you're in Japan, and you want to trade whatever the South Korean coin is, or whatever the South African rand, which are traded very small. There aren't many liquidity providers. The spread goes up because the cost charged to the broker by the liquidity provider is higher. Okay. Now, the thing about CFDs is they are designed for quick trading. But that doesn't mean CFD doesn't close until you take the opposite direction. It means you can leave it open overnight, the next day, the next day, the next day, the next day. Now, there are some small costs to this. Now, you can only keep the CFD open if you can cover the leverage. So in other words, if Google was at 150, you put your stop loss at 147, say, okay, and Google never went to 151, 152, and your little source told you the announcement was delayed. You can keep that open to the next day or the next day, as long as it doesn't fall below 170.47, because that's where you instructed the computer to close your trade. Okay. Now, you can go back and change your instructions to the computer, but if it falls below 145, which is equal to the deposit you put down, the $1,500 you put down, okay, or the 15,000 if you bought 1,000 shares, okay, your broker might give you a margin call. In other words, saying you've got to put more money up because now the asset is worth less than your deposit. Okay. So never trade what you do not understand. Do not get yourself sucked in by leverage and get in positions that are larger than you can afford. Remember, no matter what you're trading, no matter what style, it's all about risk and control your risk. So what is a CFD? It's pretty simple. It's the difference between where a trade is entered and exited in a contract for difference. A CFD is a tradable instrument that mirrors the movement of the assets underlying it. It allows for profit or loss to be realized when the underlying asset moves in relation to the position taken. Now, CFDs are undoubtedly one of the most widely traded financial instruments in the UK as well as the European markets. Growing in popularity as traders around the globe become more familiar with what they are and how they can be utilized in part of their portfolio. Now, they are traded predominantly off exchange, meaning stocks are traded on an exchange and they're automatically, filed and handled by the exchange. A CFD is traded with your broker and it's a derivative, although it's regulated, licensed, and monitored by the regulators, means that it doesn't have to go through all that costly paperwork.
Closely at one of the most popular and innovative investment tools, contracts for difference, mostly called CFDs. CFDs allow you to trade on the price movements of any financial market, like stocks, commodities, indices, or currencies, without actually owning the underlying instrument. If you think the price of an underlying asset will go up, you can buy a CFD and benefit from that rise. This is called going long. If you think the price of an underlying asset will go down, you can sell a CFD and profit from that fall. This is called going short. The profit or loss you make is the difference between the price when you entered your position and the price when you close it. The more the market moves in the anticipated direction, the more profit you make, but a position can also move against you, resulting in a potential loss. When you buy a CFD, you don't have to pay the full value of the position, but only a fraction, otherwise known as the margin. This practice is called trading on margin. By trading on margin, you're able, though not obligated, to purchase more than you normally would. This is known as the leverage effect, and is the main reason why investors like to choose CFDs. For example, let's say stock ABC is trading at $10. You think the company's price is about to go up, so you buy 1,000 CFDs. Company ABC has a margin rate of 10%, which means you only have to deposit 10% of the total value of the trade as position margin. So, since 1,000 CFDs at $10 is $10,000 and 10% of 10,000 is 1,000, your position margin is $1,000. Now, let's say your prediction turns out to be correct and stock ABC is trading at $15. Your 1,000 CFDs multiplied by 15 now equal $15,000. So you made a profit of $5,000 on your position while only investing $1,000. However, keep in mind, just like you can experience higher percentage returns with a CFD if the underlying stock goes up, you can also experience higher percentage losses if the stock goes down. Here are 4 reasons why you should trade CFDs. First, you can profit in both rising and falling markets. Second, due to the leverage effect, you can use your capital very efficiently. Third, the transaction costs are very low. And fourth, CFDs are flexible instruments that allow 24-hour trading and fast execution. Those are the basics.
And CFDs have built-in leverage. Now, CFDs provide much higher leverage than traditional trading. Standard leverage in the CFD market begins as low as 2%, depending on the underlying asset, and the margin required may go up to 20%. Now, again, leverage is controlled by the regulator. So it depends on who regulates the broker. So if you're in the UK, it's the FCA. If you're in Europe, it can be any of the European regulators. But they have all standardized leverage. Where in Australia, the Australian regulator who is regulating CFDs, and for brokerages based there, it's the leverage allowed by the Australian regulator. In Canada, it's the leverage allowed by the Australian. You'll find today that all the regulators talk to each other, and leverage is virtually the same from country to country to country. Now, remember, some of the biggest disadvantages of CFDs is they do appear attractive, and you can get in over your head because it requires a small amount to invest in leverage products. So you have to keep in mind all the time, risk, risk, risk. But any trader, no matter what you're trading, where you're trading, it's all about risk. Okay, and not getting it over your head, putting stop losses, understanding the type of trade you're making, understanding the types of trades that you can make, understanding the asset you're trading. So it's all about risk, experience, and knowledge.
What are CFDs?
The first thing you need to know is that CFDs are complex and risky financial products. It's important that you fully understand how they work before you decide to invest. Unlike share trading, you don't actually own the underlying asset you're trading in. A CFD is a derivative contract between you and a CFD issuer. When you trade CFDs, you're financially exposed to the changes in the value of an underlying asset while the contract remains open. The underlying asset might be a share, a commodity, a foreign exchange pair, or a market index. You can go long, which means you buy a CFD expecting the underlying asset to increase in value, or going short on a CFD means selling it because you expect the underlying asset to decrease in value.
How are CFDs risky?
CFDs are highly leveraged investment products. So let's take a look at an example CFD investment. Say you have $5,000 to invest. If you open a long share CFD position with a value of $100,000, you'll have to pay an initial margin or collateral to the CFD issuer. In this case, a tiny proportion of the exposure, like 5% or $5,000. This leverage can make CFDs seem attractive, but because you're trading with leverage, both gains and losses are magnified, and you can end up losing more than you put in. If the share price drops by 1%, you could face a $1,000 loss. That's 1/5 of your $5,000 investment before even considering fees and charges. Or worse, if an unexpected event results in a 20% fall in the opening share price, this is a $20,000 loss to you. That's your $5,000 investment gone and another $15,000 that you owe the CFD issuer. In some situations, even a stop-loss order may not prevent a loss of this kind.
What's a margin call and an automatic closeout?
If the market turns against your CFD position, you can close out your position and limit your losses, or if you keep your CFD position open, the CFD issuer will ask you to pay extra money quickly. This is known as a margin call. The CFD issuer may but may not close out your contract to prevent further losses. If your margin is not enough to cover your trading losses, you will still be legally obliged to make up the difference.
Are CFDs suitable for me?
You should only consider trading CFDs if you have extensive trading experience. Also, if you're used to trading in volatile market conditions and can afford to lose all of the money you put in and more.
What else should I know?
These are only some of the risks of trading CFDs. It's important that you read a CFD issuer's product disclosure statement, or PDS.
And knowledge. So, getting to grips with some of the nuances and pros and cons of different trading instruments is essential to building a solid portfolio. And while futures and CFDs do bear a number of notable similarities, it's important to remember they are fundamentally different products with fundamentally different characteristics. Now, futures are quite complex because futures all have an expiration date, and you're picking the month or the period for that future when you're buying that future. So you might be buying July gold. You might be buying August dairy products. Okay, and it's for that price, and the price, even though it fluctuates up and down, the prices fluctuate by different months. Future trading is a lot more complex. Now, also, when the other disadvantage of future trading is they are not, and Forex trading is they're not as liquid as CFDs. A CFD contract, since it's held by your broker, can virtually be closed at any time regardless of what the market is happening in the market. Where in futures and Forex, sometimes the markets are falling so fast or rising so fast that you can't get out of your trade at the price you want to get out of. So there are some other things to consider when choosing between CFDs and futures. They both leverage your money, which in practice means that you are charged interest by your broker. However, while the CFD, the interest is charged on a daily basis with futures, the charge is priced into the asset. But CFDs give you the advantage of being able to roll them over and hold them day after day. But CFDs are not designed to be held for 90, 120. They're not designed really to be swing traders, but you can hold your CFD till the market does move into your favor. Now, there's many trading platforms out there that are available, but make sure if you're going to trade CFDs, you start out with a demo account and learn and understand. Now, keep in mind, CFDs are leverage products. Most brokers offer very attractive trading fees. The spreads are very, very tight. They're all well published, and they're all very competitive.
Including shares, currencies, stock indices, commodities, and more. What is a CFD? A CFD is an agreement to exchange the difference in value between the price of a contract when it is opened and the price when it is closed. This means CFD trading, depending on your position, allows you to profit if the value of a share, for any market, moves down as well as up. And as you are only trading on a price derived from the underlying market value, this means you never actually own the share or asset, which can make it cost effective. How does it work? Each share or asset has a buy and sell price, known as the bid and the offer, which is derived from the underlying market. If you think the market will rise in value, you buy at the offer price, called going long. If you think the price will fall, you sell at the bid price, called going short. The more the market moves in the direction you predicted, the more profit you make. The more the market moves in the opposite direction, the more you could lose. It is up to you how long you keep the trade open. What markets can I trade on? CFD trading isn't just limited to shares. You can trade on a huge range of financial markets from all around the world. Forex, commodities, stock indices, exchange-traded funds, and many more. Do I need a deposit? CFDs are leverage products, meaning you only have to deposit a small initial percentage of your overall exposure to a market. For example, let's say you want to trade 10,000 shares in a big company. With traditional share trading, you would have to buy 10,000 shares at the full price. With a CFD, you only have to put up a small initial payment, as low as 10% of the total value. It's important to remember the risks of leverage. As your deposit is only a small part of your overall exposure, you can lose substantially more than your deposit if the trade goes against you. However, it is possible to reduce your potential losses by using a stop order. This means that a trade will automatically be closed if it goes against you by an amount you specify. What are the costs? In addition to your deposit, to open or close a CFD trade, you may have to pay a small commission, which can be as low as 0.1% for shares. Other markets, such as indices and foreign exchange, are commission-free. You may also have to calculate interest adjustments that are added or subtracted from your trade if you hold the trade overnight and consider any dividend adjustments. An example trade. The price of big company shares is currently $4.99, $5. You think the price will rise and want to trade 5,000 shares, so you buy at $5 for $25,000 total exposure, paying a 10% deposit of $2,500, which is the initial margin requirement. You pay 0.1% commission to open the trade, 5,000 shares times $5 per share times 0.1% gives us a commission of $25. It's near the end of the day and big company shares have risen to $5.10, $5.11 and you decide to take your profit. You sell 5,000 shares at the sell price, $5.10, and pay a commission on this example of $25.50. So your profit is calculated as follows. The opening level of the trade was $5. The trade was closed at $5.10, giving us a difference of 10 cents. 10 cents times 5,000 CFDs bought is a profit of $500. Costs of $50.50 with the commission, so our overall profit on the trade after costs is $449.50. CFD Summary. CFD trading is a flexible alternative to traditional trading, with access to a full range of financial markets, and allows you to make money when markets are rising or falling. You don't have to put up the full cost of your exposure to the market, and there is no fixed time period to your trade.
So CFDs are available on a huge range of different assets, including global indices, stocks, different market sectors, currencies, and commodities. Unlike futures contracts, CFDs have no fixed expiration date and no contract size. It's the other event. Like if you want to trade crude oil in a futures contract, you have to trade 5,000 barrels of crude oil. That's the size of a contract. Where CFD trading, you can trade $100 worth of crude oil. Okay. Trades are conducted on a leverage basis. While your trade remains open, your CFD account will be debited and credited to reflect daily financing charges. And if you're trading CFD, stock CFDs, you also get paid dividends if a dividend is declared. CFDs reflect the price movement and the pricing of the underlying asset for which they are based. CFDs provide access to the movement of assets by putting down a small amount of the total exposure. CFDs can be closed by making a second reverse trade of your original long or short position. CFDs are not standardized products, and every trader has their slightly own term. But all regulated brokers their CFDs are regulated under the broker's requirements. So remember, risk and the complexity of CFDs mean that they are unlikely to meet the investment needs and objectives of all retail investors. If you trade CFDs, you're putting potentially very high amounts of your own money at stake. So remember, risk management, money management, and understanding what you're doing is ultimately the most important thing you can do. So if you're ready to trade CFDs, it's time to join some of our other classes and learn more about how you read charts, how you read trends, how you do support and resistance, and some basic strategies that will help you make smart trading decisions. Because education and experience are the keys to being successful in the online trading world. Remember, open a demo account, trade with demo money, until you have the knowledge and experience to move on. And remember, CFDs are traded on spreads. The cost of trading a CFD is relatively small, and it's only taken out of the profits of the trade. It's taken when the contract is closed. So there's no additional cash outlays and nothing to get in your way of trading CFDs. So thank you very much for joining us. And please make sure you do subscribe to my YouTube channel. Have a great day now, and we'll talk to you again real soon. Bye now.